China's economy just got smaller relative to the United States. A major US think tank, the Rhodium Group, published an analysis showing China's real GDP growth in 2025 was somewhere between 2.5 and 3%, not the 5% Beijing reported. And in nominal dollar terms, China's economy has slipped back below two-thirds the size of the American economy, retreating from a peak of around 75% in 2021. If you follow financial news, you've seen this story framed one of two ways. Either China is collapsing, get out now, or everything is fine, the official numbers say so. Both of those readings are wrong. And if you're an investor with any exposure to clean energy, batteries, or Asian markets, acting on either of those takes could cost you. Because buried inside that GDP slowdown story is a fact that almost no Western financial coverage has picked up on. China's clean energy sector contributed $2.1 trillion to GDP in 2025. That's 11.4% of the entire Chinese economy. China's economy is weakening overall. Its energy sector has never been more powerful or more strategically critical. These two things are both true, and the tension between them is the most important story in energy investment right now. Let's start with the Rhodium Group finding, because understanding why their number differs from Beijing's is what matters here. China's National Bureau of Statistics reported 5.2% growth in 2025. Rhodium estimated 2.5 to 3%. That's not a rounding error. That's nearly half. Rhodium cross-references China's GDP claims against physical indicators, electricity consumption, freight volumes, satellite nighttime light data, and corporate earnings. These are harder to manipulate than the headline figure. Their key finding? China's fixed asset investment, the largest single component of GDP, fell 11% in nominal terms between July and November 2025. That kind of collapse simply cannot coexist with 5% headline growth. History offers no example of a country growing at 5% while experiencing 10 consecutive quarters of deflation. China has had exactly that. In nominal US dollar terms, which is what matters for global investors, China's economy has retreated to around 62 to 65% of US GDP, down from a peak of 75% in 2021. That's a significant strategic shift. The narrative of inevitable Chinese economic dominance has stalled, possibly permanently. The structural causes are well documented: a property sector in prolonged distress, aging demographics, weak domestic consumption, and a high-debt local government system that's running out of room to stimulate. Now here's where it gets interesting and counterintuitive. When you pull apart China's GDP data by sector, something most Western commentary doesn't do, you find something remarkable. China's traditional engines of growth, property, infrastructure, conventional vehicles, all contracted as a share of GDP. Together, these older industries declined by around 6 percentage points between their peak and 2025. The pickup from new sectors, EVs, batteries, solar, AI, robotics, was less than 1 percentage point in total. That gap is enormous. And it tells you something critically important about where China's economy actually is. Here is the number that changes everything. Clean energy sectors contributed 15.4 trillion yen, $2.1 trillion to China's GDP in 2025. That is 11.4% of the entire Chinese economy, comparable to the entire economy of Brazil or Canada. Clean energy accounted for more than 90% of all new capital deployed in China in 2025. Without clean energy growth, China's reported 5% figure would have been closer to 3.5%, a miss on its own stated target. Think about what that means structurally. The Chinese government has staked its macroeconomic credibility on hitting 5% growth, and clean energy is now the sector carrying that number. This is no longer just industrial policy. Clean energy is now load-bearing infrastructure for the entire Chinese economy. The three sectors driving this are what Chinese policymakers call the New Three: EVs and batteries, solar panels, and wind plus grid equipment. EVs and batteries alone delivered 44% of clean energy's total economic impact in 2025, and China invested more in clean energy in 2025 than the United States invested across its entire economy in comparable sectors by a wide margin. So what does this mean in practice? Let's work through 5 specific investment implications. First, clean energy is structurally untouchable in China's policy framework. When a sector becomes load-bearing for headline GDP, it cannot be the victim of austerity. Beijing cannot afford to slow clean energy down. For investors, this means regulatory risk in China's EV and battery sector is lower than it appears from the outside. Don't exit CATL, BYD, or their supply chains on macro GDP headlines alone. The policy flaw is real and structural. Second, the export imperative intensifies permanently. China's domestic consumption is weak. It's been weak for 3 years. Battery exports grew 41% year-on-year in 2025. Chinese solar and EV companies are accelerating into Southeast Asia, Latin America, and Africa, not because they want to, but because domestic demand isn't there to absorb capacity. For Western manufacturers, this is a permanently more competitive environment, not cyclical, structural. Third, China is exporting deflation, and with it, dependency. Solar panel prices have dropped over 50% since 2022. Battery cells are approaching $50 per kilowatt hour. This makes clean energy dramatically cheaper everywhere, but it comes with a string attached. Countries building out their grids using Chinese hardware are locking in a supply relationship that's hard to unwind. The cheap hardware is the entry point. The dependency is the long-term position. Fourth, the New Three concentration creates a new risk. EVs, batteries, and solar are now carrying more than a third of China's GDP growth. That means monthly China EV sales data is no longer just an auto sector signal. It's a leading macro indicator. A sustained EV sales downturn in China would ripple through GDP, investment sentiment, and Beijing's policy response in ways the market currently isn't pricing. Monitor it monthly. Fifth, coal hedging reveals Beijing's real anxiety. Despite the clean energy boom, China invested over $54 billion in coal in 2025. Why? Because China's grid hasn't expanded fast enough to absorb all the renewable capacity. Curtailment rates are rising. Beijing doesn't trust grid stability enough to remove coal as insurance. This anxiety is itself an investment signal. Whoever helps China solve its grid stability problem has a significant business opportunity. Grid storage, smart grid technology, and transmission infrastructure are undersupplied, and that is one of the clearest near-term opportunities in China's energy sector. Let me end with the framing question, because the rhodium finding is already generating 2 reactions in markets, and both of them will cost investors money. The first reaction: China is collapsing, get out of everything. This misreads the data entirely. A weakening economy propped up by a $2.1 trillion clean energy sector is not the same as a collapsing energy sector. The industrial capacity is intact, the technology is advancing, the export machine is running faster than ever. The second reaction: the official 5% number is real, nothing to see here. This ignores everything rhodium documented. A trade-dependent growth model under rising tariff pressure with structurally weak domestic consumption, that's genuinely fragile. Don't be complacent. The clear mind holds both truths simultaneously. Before every investment decision involving China's energy sector, ask yourself three questions. 1. Is this company export-dependent or domestically anchored? Export-dependent names carry trade war risk. Domestic grid and storage plays are more insulated. 2. Is this company in the new three or just adjacent? EVs, batteries, and solar are policy protected. Adjacent sectors do not carry the same political flaw. 3. Does this company have a technology moat or just volume? A weakening economy accelerates consolidation. Volume without margin is the most vulnerable position. The investor's North Star in this environment is this: China's GDP story and China's energy story are diverging, not converging. The economy is slowing, the energy industrial complex is accelerating. Conflate the two, and you'll either panic sell the wrong things or stay complacent in the wrong things. The discipline, the actual edge, is to hold both facts simultaneously and act on the energy story, not the macro headline. That's the full picture for episode 1. We covered the Rhodium Group finding, what's actually underneath the GDP number, the clean energy paradox, 5 specific investment implications, and the framework for keeping a clear head when the headlines are noisy. In episode 2, we're going one level deeper, into the export imperative specifically. China's domestic economy is weak, its export machine is running at full speed, and that combination is reshaping competitive dynamics for battery and solar manufacturers across Europe, the US, and Southeast Asia. That's coming in the next 10 days. If today's video gave you a cleaner lens on this story, hit subscribe. If you're an investor or analyst tracking this space, share this with someone who's reading the GDP headlines the wrong way. And drop your take in the comments. Do you think China's clean energy sector can keep carrying the macro weight? I read everything. I'm Michael. This is Power Transition Asia, and I'll see you in episode 2.